Hello and welcome. My name is Katie Gibbs and I will be presenting the Angus Jones Investment Analysis of Warf Computers Inc. for 2010. This presentation will provide a cash flow analysis to determine whether Warf's recent expansion plan is a viable investment. Does Warf have what it takes to be the next Apple? We pose this question because once upon a time Apple was just a small startup tech company, and today they're the leading tech company on the market and one of the most successful companies in the world. Their name has become synonymous with cutting-edge technology. This brings us to Warf's newest invention, the virtual keyboard, which has the potential to bring Warf to the next level to compete with innovative leaders such as Apple. But are they ready to make the leap? In this presentation, we will seek to examine this question. This presentation will seek to provide background information on Warf, explain our analysis methodology, review the balance sheet and income statement as provided by Warf, provide an accounting cash flow statement and financial cash flow statement in order to provide a cash flow analysis, as well as perform a ratio analysis to determine if the company is profitable, can sustain growth, and can sustain new debt. Lastly, in our conclusions and recommendations section, we will examine important questions. What are the risks? What are the benefits? And should Warf expand? Is this a sound investment? Let's start by talking a little bit about Warf Computers. Warf is an independent tech startup created by computer programmer Nick Warf in 1995. Nick and his friends provided the limited investments necessary until now. Their newest invention, the virtual keyboard or VK, is a hybrid of software and hardware and is a full generation beyond what is currently on the market. It relies on sophisticated artificial intelligence algorithms that allow this user to speak naturally as the computer converts their speech into text. It corrects spelling and grammatical errors, formats the document according to preset user guidelines, and suggests alternative phrasing and sentence structure, providing detailed stylistic diagnostics. Now, in order to research and develop, produce, market, and sell the VK, Warf will require significant external financing. Both the accounting statement of cash flows and the financial statement of cash flows was prepared based on the following items provided by Warf: a 2009-2010 balance sheet, the income statement from 2010, and additional notes to the above financial statements involving net new borrowing, net new equity, and net capital spending. Let's take a look at the balance sheet. As you can see, cash increased from 09 to 10. They also had an impressive accumulated retained earnings of $1.5 million in 2010. We have highlighted the total assets and total equity to show there is growth from 2009 to 2010. And as we will see in later slides, the returns on these both show efficient management of resources. When we look at the income statement, we have highlighted sales, earnings before interest and taxes, and net income, as they will provide the basis for our analysis. Now, what observations do we make by looking at the income statement and balance sheet? We see that total assets increased by 18.8% and that new net capital spending increased $647,000. When we look at the return on assets, return on equity, and operating profit margin, we see that these are very healthy ratios. This shows us that even with an increase in new net capital spending in the form of investment in fixed assets, the company was still able to maintain healthy rates of return. This shows that the managers are fiscally responsible and effective users of resources. This is a good indication of how additional investments will be treated. Let's move on to the cash flow analysis. After creating an accounting statement of cash flows and a financial statement of cash flows, we observed no major discrepancies between the two that would cause a red flag for concern. The statements indicate that the finances were generally well managed. It is also very important to note that the financial statement of cash flows provides a more accurate description of the cash position as it illustrates the degree of available cash flow for servicing additional long-term debt and the associated financing costs. We also plan to look at the operating cash flow and cash flow to creditors. When we look at the statement of cash flows, we see that in 2010, the accounting statement of cash flows shows that we have a total positive cash flow of $290,000, which is an increase of $39,000 from the previous year. This was due to a large cash flow from operations of over $900,000, which was able to offset elevated spending on net fixed asset acquisitions of $647,000. When we look at the financial statement of cash flows, we see that there was a total cash flow from assets of $316,000. This represents the surplus cash that can be used for both debt and equity after operating expenses have been covered. Their operating cash flow was $1.1 million, most of which was used for capital investment. They also easily serviced their debt with cash flow to creditors of $75,000. In addition, Warf paid $212,000 in dividends in 2010, which accounts for 19% of their operating cash flow. Since potential creditors will have priority over the dividend payout should the company's profits decline, the fact that dividends are being paid out in 2010 is a good sign and an incentive to lenders because it serves as an added buffer against uncollectible debt. According to the additional financial information provided by Warf, the company incurred $20,000 in new debt while retiring $20,000 of new equity, a move that provided a net cash flow to stockholders of $9,000. In addition to being a strategic decision for preserving stockholders' equity, this may have also been intended to better value their stock for any future investors. Knowing that they would need additional capital for upcoming projects, they likely attempted to position their stock price higher by repurchasing outstanding debts and paying out large dividends in order to appeal to more investors. Now let's move on to the ratio analysis. The times interest earned coverage ratio of 14 shows that the amount of interest being paid out is covered by cash 14 times. This shows there's more than enough room to incur additional debt while still having the ability to pay the additional interest for the new debt. Warf currently does not have a large amount of current debt compared to its earnings for the year. We have seen that Warf has incurred an additional $20,000 of new debt in 2010, which is still marginally low when compared to the $1.1 million in operating cash flow. At the current rate, Warf has the capability to incur an additional $20,000 in interest outflow and still maintain a healthy times interest earned coverage ratio of 10. It should be noted that comparing the cash flow statement to the balance sheet, we see an outstanding long-term debt of $968,000. Though current debt in 2010 seems low, it will be prudent for potential investors to see how much of this debt will mature in the upcoming year. When we move on to the operating cash flow ratio, which is 1.84, we see that that company is generating enough cash to cover the cost of its current liabilities 1.84 times for the annual period. A ratio of less than 1 would indicate that Warf is not generating enough cash to cover their current liabilities. But since we have a healthy ratio of 1.84, we see that the company is operating with a large amount of cash inflow and has the ability to cover its current expenses. Similarly, the cash current debt ratio for Warf is 1.8. This means that the company is able to meet the current debt commitment 1.8 times for the year. Under standard guidelines, a ratio greater than 1 is desirable, while a ratio of less than 1 would indicate a high risk factor. 1.8 is a very healthy ratio. Now when we move on to sustainability analysis, we see that Warf can naturally expand by another 35% before the need for additional financing. A growth rate of 35.1% would yield an increase of $868,000 in net income, assuming a 40% tax. It would also increase net sales $1.7 million, which represents the maximum that future sales can increase without the need for additional fixed assets. So what are the risks? First, we have to see excessive development and production lead times and what effect they'll have on their ability to pay back long-term debt. Warf's ability to maintain future debt expense will depend on how rapidly the VK can complete the R&D phase and how quickly customer commitments can be fulfilled. If the VK remains in research too long due to technical problems, or if there are persistent production issues, they might not have the income to generate the cash flow for investors and creditors that they currently have. Secondly, there are product demand concerns. Warf's viability to obtain external financing assumes that there will be sufficient demand for the VK product. Any prospective investor or creditor needs to consider the sales forecast for the VK, as this will be critical in determining their ability to repay any long-term debt. Further study of the potential market is thus vital. So what are the benefits? Risk factors notwithstanding, their expansion plans to develop the VK appear to be a sound investment. Both the accounting and financial cash flow statements show strong cash inflow for 2010. The balance sheet and income statement indicate that Warf is not only profitable, but growing. The results of the liquidity ratio analysis also indicate that Warf has an adequate cash flow for 2010 calendar year, and that their management team is running the company efficiently and responsibly. They have strategically positioned themselves with large investments in capital spending for the upcoming year and taken measures to better value their stock prices in order to attract investors. Overall, the company seems well poised for additional investments in R&D and production. The cash flow analysis has shown that the company is profitable, and therefore expanding the VK program is deemed to be both viable and sustainable. So now the big question, should Warf expand? Well, Since we've seen in this analysis that Warf is innovative, profitable, viable, and sustainable, our final recommendation would be to go for it. Warf has shown that they can effectively stimulate cash from investments and receive healthy returns on both assets and equity, as well as maintain profitability while spending money on growth. It has also been profitable for creditors. They have retired debt and paid out dividends in 2010. The VK is viable and innovative because it is cutting edge and will have great market capitalization potential. By examining the cash coverage ratio and times earned interest ratio, we see that the company is in a good position to cover its current debt as well as take on new debt. The company has shown that it can sustain profitability during periods of growth and can therefore look forward to expansion optimistically. We hope that you'll consider our analysis in your decision making, and thank you so much for your time.